Jobs numbers came out on Friday and they surprised the markets as they looked a lot better than what many expected. January added 467,000 jobs versus the expected only 150,000. Not only that, but November and December's numbers were revised massively upwards as well. This improved almost all of the job and employment measures that you can look at, all except for one. This basically seals the deal on the Federal Reserve moving forward with its plan to taper its balance sheet and to raise rates. Ready? Let's dive in. All right, first let's look at November. The original November numbers were about 250,000 jobs added, and that was just revised upward to 650,000 jobs. December also was revised from about 200,000 jobs up to 510,000 jobs. So obviously those are some big revisions. And in January it was expected that about 150,000 jobs would be added, but in reality the number ended up being about 467,000. In terms of unemployment here, you can see that it has been on a very steady decline, and this last month has been a little bit of a steeper decline as compared to the recent trend. Right now for long-term unemployment, that puts us at about 1.7 million people long-term unemployed. Now all these numbers kind of go in one ear and out the other, and you don't really know how those numbers fit into the overall scheme of things. So that's where I like to take a look at my favorite indicator of what the labor force, what jobs and unemployment looks like in the United States, which is the labor force participation rate. This is the most complete and broad overview of the jobs picture. And indeed, if we look here, we can see a sizable jump in the labor force participation rate. Keep in mind, this drop was a historic drop that happened in March and April of 2020. It was absolutely massive. And so we're making progress, but we're nowhere near getting back to the level that we were before. Now, last time I used this chart, I was a little bit surprised. I got a lot of questions in the comments basically saying this is a chart crime. If you look, it goes from, 60 to 63. And newsflash, this is how charts work. When you look at a chart, the top is supposed to be the highest in this series, and the bottom is supposed to be the lowest in this series. If I would have manipulated this to make it look smaller so that the y-axis showed something other than from 60 to 63, if it showed from like 0 to 100, that would be manipulating the data and presenting a deceptive point of view because it doesn't represent reality. It's trying to that'd be making it look like it was smaller than it really was. And the way that you know this is by zooming out. Look at the last 50 years. Clearly, that's a big change. It doesn't matter what the y-axis is when you're looking at it from a broad historical view. Yes, the numbers 60 and 63 sound pretty close together. That's meaningless. In light of history, in light of long-term trend, that was an enormous drop. Heck, it took 5 years in the 70s to go from 60 to 63, which we lost in a couple of months. And the recovery right now looks a little bit faster than it took us to go from 60 to 63 in the 70s here, as we've made up about half that ground in just about 2 years. Now, labor force participation rate, this is the one that I like, but it is not the one that the Federal Reserve is paying the most attention to. Their metric of choice is going to be job openings. And here's why they like job openings. They've got 2 mandates by Congress. One of them is maximum employment. The other one is inflation. In terms of the recent inflation, it is very clear to everybody that 7% inflation does not count as stable prices. And so they know they need to attack that. The problem is attacking inflation is at odds with achieving maximum employment usually. And usually if you're fighting one, you're also fighting the other. So they have to look at a metric for employment that gives them the freedom and the ability to attack inflation. And that's why they are looking at job openings, because they're basically saying if there's all these companies out there that have tons of job openings, there's nothing more that we can do to cause employment to go up. As long as there's job openings, people have the ability to get jobs if they want to. And so we're at the maximum employment we could possibly be given everything we have the power to do at the Fed. And until those job openings dry up and if layoffs start to happen and unemployment starts to go up instead of go down, then they might bring the employment piece back into the picture and see if they want to fight inflation as hard as maybe they will in the next couple of months. But as for now, given the job openings being at record highs, they're going to use that and say we can fight inflation as much as we want until those job openings dry up, and then maybe we change course after that. So when you combine record job openings, improving unemployment numbers, improving payroll numbers, and worsening inflation numbers, this is all just fuel on the Fed fire to fight inflation by finishing their asset purchases, raising rates, and potentially selling assets. So mark my words, most people don't believe this. They will finish purchasing assets by March, and they will subsequently raise rates. And the only thing that would get in the way of that and cause that to not happen is a too big to fail company going bankrupt, saying they're insolvent, or a GSIB, a globally systemically important bank, falling over. Now, this increased likelihood of the future certainty in interest rates going up by the Fed led interest rates to go up today. That's how markets work. You price in the increased certainty of something happening in the future. And short-term rates are rising much faster than the long-term rates. The 2-year is slowly catching up to the 10-year. And if it overtakes, that is the classic inverted yield curve that has preceded every single recession for the last 50 years. All right, back to the jobs numbers. There is one more thing that we have to look at regarding employment. And this is something that's been completely glanced over by the media. Everybody wants to look at the massive increase in jobs, and nobody wants to look at whether Americans are actually getting ahead or not. Spoiler alert, it's because they're not. Yet again, people took a pay cut. That's right. In January, wages rose by 5.7% year over year from the prior January. But inflation, as of December, is running at 7%. And when the inflation numbers come out for January, could be even higher. This means that for every $100 you got last year, this year you got $105. But for every $100 that life cost you last year, this year that same stuff costs $107. So did you really get a raise? Well, in real terms, you did not, because you can afford less now than you used to be able to. Now, many economists are starting to fear what's called a wage price spiral. This is where wages continue to rise as jobs continue to churn, as people hop from one job to another looking for a little bit higher pay here and there in order to compensate for their increased cost of living. And as those wages rise, as people jump from job to job, wages rise, they then spend that money on the same stuff because they're just trying to afford to survive, but that contributes to more money chasing the same amount of goods and services, which bids up the prices even more, which continues this devastating spiral, positive feedback loop that turns into what's called a wage price spiral. Now, I personally don't anticipate something like this happening yet. It looks like the disinflationary forces from last year of the extreme drop in the money supply growth and the lack of government spending we've seen over the last 6 to 12 months to start to catch up with markets as it builds a giant air gap under the markets right as the Federal Reserve is ramping up tightening. And then by the end of the year, we could see these things all catch up and come to a head all at once. But as for now, higher jobs, more nominal income, more inflation means more room for the Fed to tighten. Finally, I will be speaking at an event in Dallas on March 5th. I would love to see you there. If you are able to join, I've got the sign up link in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.